There's a strange feeling investors get sometimes. It happens when you wake up, open your portfolio, and see one of the strongest companies in the world suddenly losing hundreds of billions of dollars in market value. Not a small company, not a risky startup, a giant, a company that has survived recessions, tech revolutions, and decades of competition, and suddenly the stock drops hard. In moments like this, investors split into two groups. One group panics. They start asking if this is the beginning of something terrible. Is the growth story over? Is big tech finally breaking? The other group gets excited. They start saying this could be the opportunity of the decade. And then there's a third group, the quiet group, the disciplined investors. They don't panic. They don't celebrate. They do something much more boring. They start running the numbers, because in investing, two of the most dangerous sentences you can ever say are these: this time is different. And the second one is just as dangerous: I'll just wait and see. Both of those sentences often lead investors to miss the biggest opportunities of their lifetime. So today we're going to slow everything down and walk through what is actually happening with Microsoft. Not the headlines, not the hype, just the numbers and the reality behind them. And by the end of this conversation, you'll understand something important: at what price Microsoft actually starts becoming attractive again, and why what's happening right now might be a warning sign for the entire stock market. But first, let's start with the company everyone is watching: Microsoft. Over the past few months, Microsoft stock has pulled back in a way we haven't seen in quite a while. And when a company worth more than $3 trillion moves like that, people notice. When a company that big drops even a few percent, hundreds of billions of dollars disappear from the market in what feels like seconds. And that kind of move creates emotional reactions. Some investors are calling this the buying opportunity of the decade. Others are saying this is the start of a much bigger collapse in big tech. But both of those reactions miss the most important question. The real question is not whether Microsoft is a great company. We already know the answer to that. Microsoft is one of the most powerful businesses ever built. Azure continues to grow as one of the largest cloud platforms in the world. Office 365 keeps producing massive recurring revenue. Enterprise software remains deeply embedded inside global businesses, and the company is now heavily positioned in the AI race. None of that is in doubt. The real question investors should ask is much simpler: is the stock price worth the risk? Because even the greatest company on earth can be a terrible investment if you pay too much for it. That's the part many investors forget. A stock dropping from its peak does not automatically make it cheap. It simply means it's cheaper than it was before. Those are two completely different things. So instead of guessing, let's look at the fundamentals. Microsoft's most recent earnings report showed something very impressive. Revenue grew about 17% compared to the previous year. Operating income increased roughly 21%. And earnings per share jumped close to 24%. That kind of growth is incredible for any company. But for a company already worth trillions of dollars, that's extraordinary. Even more interesting is how Microsoft has been improving its efficiency over time. Over the past decade, profit margins have steadily expanded. Around 10 years ago, margins were close to 33%. 5 years ago, they moved closer to 36%. Last year, they reached nearly 39%. That means Microsoft isn't just growing revenue, it's becoming more efficient while doing it. This is what investors call a compounding machine. A business that grows bigger while becoming more profitable at the same time. Companies like that are extremely rare. So if the business is still performing this well, why is the stock under pressure? The answer is uncertainty. And right now, the biggest uncertainty in the tech world is artificial intelligence. Microsoft, along with companies like Amazon, Alphabet, and Meta, is spending enormous amounts of money building AI infrastructure, data centers, advanced chips, cloud capacity, research teams. These investments are massive, and they are happening right now. The problem is that the return on these investments is still unclear. AI could transform the global economy, or it could take longer than expected to generate real profits, and markets hate uncertainty. When investors become unsure about future growth, something interesting happens. The business doesn't suddenly become bad. Instead, the stock's valuation starts to shrink. Investors stop paying extremely high premiums for future growth, and when that premium shrinks, stock prices can fall quickly, even if the company itself is still doing great. This is exactly what we're seeing right now. And it brings us to the most important framework every investor should understand. The price you pay determines the return you receive, not the story, not the headlines, the price. So in the next part, we're going to run some simple numbers. And those numbers will show something fascinating, a price where Microsoft looks fairly valued, and a much more interesting price where the stock suddenly becomes very attractive for long-term investors. But what those numbers reveal about the broader market might be even more important, because Microsoft's situation is only one piece of a much bigger story that most investors still haven't noticed. And once you see it, you can't unsee it. Now that we understand why Microsoft's stock is under pressure, we need to answer the question every serious investor is asking. At what price does Microsoft actually become attractive? Because here's the truth most people ignore. A great company is not automatically a great investment. The price you pay determines the return you receive. If you buy an incredible business at a ridiculous price, your returns can still be terrible for years, sometimes even decades. And history has proven this again and again. So instead of guessing, let's walk through a simple way to estimate what Microsoft might actually be worth. Nothing fancy, just basic assumptions about growth, profitability, and valuation. First, let's talk about growth. Over the past decade, Microsoft has delivered very strong revenue growth, often landing somewhere between 13% and 15% annually. That's incredible for a company of its size. But smart investors rarely assume the past will repeat perfectly. So let's be more conservative. Imagine Microsoft grows its revenue somewhere between 7% and 11% per year over the next decade. That's slower than the past. And it also gives us room for potential economic slowdowns, recessions, or slower AI adoption. Next, we consider profit margins. As we mentioned earlier, Microsoft's margins have been steadily improving. They've climbed from roughly 33% years ago to around 39% recently. It's reasonable to believe they could eventually reach around 40% if the company continues improving efficiency through software and cloud services. Now we need to think about valuation. This is where many investors make mistakes. Even if a company performs perfectly, the stock price still depends on how much investors are willing to pay for each dollar of earnings. Historically, the overall stock market trades around 15 to 20 times earnings. But premium companies like Microsoft often command higher valuations. So let's assume that 10 years from now, Microsoft trades somewhere between 20 and 26 times earnings. That would still place it above the market average, which makes sense for a high-quality company. Now, when we combine these assumptions, something interesting appears. We get a range of potential intrinsic values. At the lower end of the range, Microsoft appears fairly valued around $400 per share. Not cheap, but not wildly expensive either. At the midpoint of these estimates, the intrinsic value moves closer to about $480 to $500. And at the high end, if Microsoft manages to sustain the stronger growth it has delivered in the past, the valuation could easily reach $600, $700, or even higher over the next decade. What does this actually mean for investors today? It means Microsoft is sitting in a very uncomfortable zone. It's not clearly cheap, but it's also not obviously overpriced. This is the part of the market where impatient investors usually make mistakes, because when a stock sits in the middle like this, it often moves sideways for long periods of time. Nothing dramatic, just slow movement while fundamentals gradually catch up to the price. That can feel frustrating for investors who want quick gains, but for patient investors who think in decades, this kind of environment can still work very well. Compounding at 12% to 15% per year might not sound exciting at first, but over 10 years, that kind of return can completely change someone's financial future. However, there's another level to this conversation, because serious investors always look for something called a margin of safety. This idea became famous through legendary investors like Benjamin Graham and Warren Buffett. The concept is simple. You don't just buy a stock when it's fairly valued. You try to buy it when it's clearly undervalued. You give yourself room for mistakes, room for uncertainty, room for unexpected problems. And when we apply that thinking to Microsoft, something interesting appears. The real margin of safety probably begins closer to $350 per share. At that level, the potential reward starts to clearly outweigh the risk. If the company performs well, investors could still see strong long-term returns. And if growth slows temporarily, the downside becomes much more limited. This is why experienced investors often wait patiently for prices that make the math work in their favor, because patience is one of the biggest advantages individual investors have. Large institutions often can't wait. They have performance pressures, quarterly targets, and client expectations. But individual investors can sit on cash and wait for the right price. And sometimes that patience creates incredible opportunities. So here's an interesting question for you. Are you currently holding Microsoft stock? Are you watching from the sidelines? Or are you already buying the dip? Investing decisions are rarely black and white. Different investors have different time horizons, different risk tolerance, and different financial goals. But Microsoft is only one piece of the story, because when we zoom out, we begin to see something much bigger happening in the overall stock market, something that most investors are not paying attention to. Now we need to zoom out, because Microsoft is only one part of a much bigger story happening inside the stock market right now. And this story is far more important than whether Microsoft trades at $400 or $350. It has to do with how concentrated the entire market has become. Most investors believe they are well diversified. They own an S&P 500 index fund. They feel safe because the fund holds 500 companies. That sounds like broad diversification, but here's the reality most people don't realize. The S&P 500 may contain 500 companies, but the market's performance is heavily controlled by just a handful of them. Right now, the top 10 companies in the index make up roughly 38% of the entire market value. Think about that for a moment. 10 companies out of 500, that's just 2% of the index, controlling almost 40% of its weight. And those companies are names everyone knows: Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta. These giant tech companies have become so large that they dominate the entire market. So when they rise, the index looks amazing. And when they stumble, the entire market feels it, even if the other 490 companies in the index are doing just fine. This creates a very unusual market structure, one where investors believe they are diversified, but are actually heavily concentrated in a few mega cap stocks. And history has shown us that this kind of concentration can eventually create problems. We've seen something similar before. You know, the late 1990s technology bubble was built on the same idea. A handful of tech companies captured most of the market's attention and most of the market's capital. Investors believed those companies could grow forever. Prices skyrocketed, and for a while it worked beautifully until it didn't. Now here's where things get even more interesting. There are a few valuation metrics that long-term investors watch closely. These metrics don't predict short-term movements, but they do give a sense of how expensive the market is compared to history. One of the most well-known metrics is the cyclically adjusted price-to-earnings ratio, often called the CAPE ratio. This measure averages 10 years of inflation-adjusted earnings to smooth out short-term fluctuations. Historically, the CAPE ratio averages around 17. At the peak of the dot-com bubble in 1999, it reached around 44, the highest level ever recorded. Right now, it's sitting close to 40. That puts today's market extremely close to one of the most expensive levels in history. And that's not the only signal. There's another metric famously used by Warren Buffett to evaluate the overall market. It compares the total value of the stock market to the size of the US economy. When this ratio becomes extremely high, it suggests stock prices may have run ahead of economic reality. At the peak of the dot-com bubble, this metric showed the market was roughly 45% above fair value. Today, that gap is even larger. Some estimates suggest the market sits more than 120% above fair value using this measurement. That's an extraordinary number. Now, before anyone jumps to conclusions, it's important to say something clearly. High valuations do not automatically cause a market crash. Markets can remain expensive for years, sometimes even longer, but what high valuations do affect is something more subtle: future returns. When investors buy stocks at very high valuations, the returns over the next decade tend to be lower than average, not because businesses stop growing, but because the starting price was already too optimistic. This is something history has shown again and again over more than 100 years of market data, and there is a famous example that perfectly illustrates this idea: the early 2000s. From the year 2000 through about 2012, the S&P 500 delivered almost no overall return, more than a decade of basically flat performance. Think about that. 12 years where investors saw almost no growth in the index. And yet during that time, the American economy kept growing. GDP increased dramatically, corporate profits improved, new industries emerged. Companies like Google, Facebook, and Tesla were born during this period. Innovation didn't stop, but the stock market went nowhere. Why? Because prices in the year 2000 were already extremely high. Investors had already paid in advance for years of future growth, so the market needed time for reality to catch up to those prices. One of the most fascinating examples from that era is Cisco. In the year 2000, Cisco was the most valuable company in the world. Its technology powered the internet infrastructure that everything relied on. The business itself continued to grow in the decades that followed. Profits increased multiple times. By most business standards, Cisco was incredibly successful. But the stock, it took more than 20 years just to return to its previous peak price. The business grew, but investors who bought at the bubble price had to wait decades to break even. And Microsoft actually experienced something similar. After the dot-com crash, Microsoft stock traded sideways for more than 10 years. The company remained profitable and continued growing, but the valuation had been so extreme that the stock needed years to reset. By around 2012, Microsoft was trading at only 8 or 9 times earnings. That's when disciplined investors quietly started buying again. And what happened next? One of the greatest stock runs in modern history. The lesson here is powerful. Great companies can still be poor investments when bought at extreme prices, and patient investors who wait for realistic valuations often benefit the most. But here's the twist. For younger investors, a long period of flat markets might actually be a good thing.